Hi, everyone. Welcome to Economic Insights for the month of October 2022. I'm Jessica Edgerton, EVP of Operations and Corporate Counsel with Leading RE. So happy to have Marcy back. Marcy and I actually got to see each other in person last month in Portugal for our global symposium. She rocked the stage there. I think we might actually have a few people on our attendee list for today who got to see you then. But man, things keep moving, and it will definitely not be a repeat from what it was 2 weeks ago, will it, Marcy?
No, nothing ever stays the same, does it, Jess?
It does not. Let's start today with the consistent headline topic, which is inflation. So in September, we were in the US seeing a pretty consistent sort of high and steady of 8.2, not much change from August. But that number isn't necessarily reflected across all goods and services, right? We're seeing some good news in terms of consumer pricing in some sectors. Talk us through the inflation landscape right now and what we might be seeing towards the end of the year here.
Sure. Well, I want to remind everyone that the headline number, the 8.2%, was down from its peak in June of over 9%. So inflation is actually down 100 basis points. I really hoped that I would have better news, right? That it would be down, all the way down to 7.5% by now. But it's moving a little bit slower than what we would have expected, mainly because there's been this shock to food prices over the last 3 to 4 months, where we've seen food prices, particularly in grocery stores, take a real ratchet up this fall. But as you sort of mentioned, all categories are not the same. And one of the big drivers of inflation over the last 3 years has been the surge in automobile prices. And that appears to be completely overwhip. And in fact, used car prices have been edging down month over month. So as a category, one of the biggest drivers of inflation were automobiles, both new and used. They've come down, as we saw this morning in a retail sales report, which just came out, something that I'm watching very closely to sort of get a sense of how consumers are reacting to inflation. Are they pulling back completely and not spending money, or are they just spending money differently? And it appears as if up to this point, they are still spending money. They're just spending money differently. So they have cut back on spending on automobiles. That's one category. And so the laws of supply and demand still seem to be holding, that if demand falls, then prices tend to fall. And if demand surges, then prices tend to go up. And so we've got to remind ourselves, one of the reasons we've had so much inflation over the last 3 years is that consumer demand, which was sort of helped by so much stimulus money, and the fact that during the COVID recession, you would have normally seen people lose their jobs, but because we could all go remote, we didn't. So instead of spending our money on travel and eating out, we spent our money on big ticket items, and it's caused the price of those goods to surge over the last 3 years. Things in terms of spending are now going back to normal. As you pointed out, we got to travel to Portugal. Today, I am in San Diego at the beautiful Hotel del Coronado, coming to you from a live and in-person conference that I'm attending here. And so we're going back to spending money the way that we used to. And that's being reflected in the retail sales number and in the fact that some categories of inflation are going up, like food, but some are coming down as demand for many of those products that was so strong 3 years ago is now going back to something that looks much more normal.
One of the big categories of spending that we've all had our eyes on is gas, oil, energy, right? So regarding gas prices, we've seen a little dip in prices, and in some, depending on where you are located, a more significant dip than others. But then last week, we heard some news out of OPEC. OPEC made a very controversial move to cut oil production. So what's behind that, and what is going to be the global impact? And while we're talking global, it's a sort of a part two here, but what is going on with the UK right now? I mean, there is an implosion. I would not want to be Liz Truss right now, right? She has her hands full. So tie those two
Liz
together.
Truss ought to be listening to us right now. She needs some advice terribly, terribly. But let's back up and talk about OPEC, right? So we're going to talk about OPEC really quickly. Typically, when OPEC is concerned about prices falling because demand is falling, they tend to cut back on output. And one of the things you need to notice, though, when I actually looked at the charts, OPEC wasn't even hitting their old targets. So this is not, I would say, a real meaningful cut. It's just an acknowledgement that they can't hit the targets that they were attempting to hit before. So you've got a situation where I know that OPEC is concerned about demand falling in the rest of the world, and falling demand tends to put downward pressure on prices because OPEC understands this. They've been through this before. The world is really divided into two kinds of countries: countries that import oil and countries that export oil. And at stressful times like this, as oil prices surge, it puts real stress on oil importing countries. And when you have a food price surge happening at the same time, particularly in lower income countries where many people are at subsistence level living, you will see a big drop off in demand. And this is what OPEC is fundamentally concerned about. You've already seen places like Sri Lanka devolve into significant political upheaval because of these forces. On top of that, as you and I, Jess, have discussed before, China, which is a huge importer of oil, is really sliding into a pretty tough recession themselves. So they've got sort of COVID-19 restrictions that depress demand for oil anytime industry shuts down there. So demand for China is not what it was 3-4 years ago. So China's a net importer of oil. So the world is kind of dividing up between those who import energy and food and those who export energy and food as to how their real economies are going to weather what is going on. And I have said this many times before, that OPEC is not nearly as effective at controlling oil prices as they were in the 1970s and 1980s, because the US is on par with Saudi Arabia in terms of our production, and we're not part of OPEC. And so OPEC is no longer the control over oil prices that they had decades ago. So they make big political headlines. They're not nearly as effective. And I actually don't believe that their production cuts are going to have much impact on the downward pressure that oil markets are facing, that we've seen, because demand from China is so weak and the US is producing, as the rig count continues to steadily go up, more and more and more. Now, the UK finds itself in the unfortunate position right now of being a country that is a net importer of energy and a net importer of food. So if you feel like inflation in the US is tough, it's even worse in the UK. So they're struggling with inflation at 10%. And they also have quite a bit of political turmoil within their government. So they get a new prime minister in the form of Liz Truss, because Boris Johnson is now gone. And the first thing that Liz Truss does is come out with a plan to cut taxes aggressively. And bond markets are not taking that well right now. It's sort of the return of the bond vigilante, which is sort of a term from the late 1990s that everybody might remember. But as soon as they announced those big tax cuts, which would have been a lot of fiscal stimulus to the British economy, which would of course fueled inflation even more, we saw the interest rate on government debt in Britain surge. And so this got pension funds into trouble. And now you've got a new politician trying to sort of walk all of that back. Layered on top of Brexit, which we sort of forget because it happened such a long time ago. But the full effects of Great Britain withdrawing from the European Union are just now beginning to be felt in a really stressful way. So it's never one thing, Jess. I've said this over and over again. When you get this kind of turmoil in a country, you can't ever just point the finger at one thing. But when 4 or 5 things come at them at once, which is basically what they're dealing with, it's a real struggle to right the ship in the midst of all this.
Europe as a whole, of course, is dealing with a lot right now as well. Do you see a similar trajectory there? If not, what are the differences between UK and Europe as a whole?
Well, Europe is facing a significant energy shock. Natural gas prices, which they use to heat their homes and fuel their industry, as natural gas, the pipeline continues to be stressed from Russia, will most likely be cut off during the winter. Europe is facing this shock to energy prices. I have to tell you though, Jess, and I've sort of people have heard me say this over and over. It's never the disaster I can see coming that I worry about. It's the one that I don't see coming. So Europe has had 9 months to prepare for this. So what that means is it's likely to mitigate um, some of the negative effects. So even though I don't think Europe will be able to skirt a recession, they probably will experience a recession because growth in Europe tends to trend at about 1%. So it's not hard to knock it below zero. It's not hard to get a contraction in an economy that doesn't grow very quickly anyway. That's sort of what we observe in Japan. But at the same time, having had 9 months to prepare for it will make it a lot easier than it would have been if it was a shock that no one saw coming. So again, it's sort of this idea of it's sometimes the things that don't happen to you that you should be really grateful for. For instance, I was very concerned last month when there was a threat of a railroad strike in the US.
Yeah.
I'm going to just tell you right now that I do believe that would have thrown the US economy into recession in the sense that it would further have disrupted supply chains that are just now beginning to return to normal. So, had you shocked the US economy with that unexpected railroad strike, I do believe that could have caused a recession in the US. So, sometimes we do have to be grateful for the things that don't happen to us as opposed to the things that do.
We're going to turn to the US and specifically to the housing market in a minute. But before that, one more global question here, which is Venezuela is a huge, I mean, they are sitting on huge reserves of oil and energy. What are your thoughts as sort of there are some rumblings about maybe opening back up to that as a possible,
Well,
a
I happen to
possibility?
be quite supportive of that move, not because I am supportive of the Venezuelan government. And I want to be very clear, I'm an economist. I'm not a political scientist. I'm not a politician. I am not an expert in foreign policy. But what I will say, having observed economies, sanctions, all these things over many, many decades, is that they don't tend to be particularly effective in bringing about regime change. So, of course, you never want to actively support governments that do things that sort of violate human rights and things that we don't support as a free and democratic nation. But at the same time, we learned from the experience of Cuba that sanctions don't necessarily bring regime change, but they do bring great humanitarian harm. And we're seeing that as Venezuelans pour into the U.S. um, seeking shelter, seeking asylum, that maybe it's in everybody's best interest in this point, at this particular point in time, to ease some of those sanctions and allow the Venezuelan oil industry to come back online, supply oil to global markets, bring prices down, ease some of the inflation, and maybe ease some of the humanitarian crisis that is driving people into the US right now.
Let's talk a little bit about Fed activity in the US. So we are hearing that there is going to be another 75 basis point raise in November, maybe again in December. I mean, this aggressive activity by the Feds is continuing. We're still seeing high inflation. Is it possible that we're actually now they've done their work and they need to cut it out? I mean, is there going to be an overcorrection that we're going to see, and everything that we're experiencing now is just sort of a lag, or is that crazy talk?
I don't think it's crazy talk. We do know that monetary policy acts with at least a 6-month lag. So the 6-month lag is the rule of thumb. The Federal Reserve has been raising rates since December of last year. So we're 10 months into the strongest tightening cycle in 40 years. But the problem for the Federal Reserve, of course, is that their credibility is on the line. Same thing with the Bank of England, same thing with the European Central Bank, that the perception now is that central banks were that cliche behind the curve a year and a half ago, and now they have to reestablish their credibility, which we know from the experience of the 1970s is extremely important. But one of the big differences between the 70s and 80s, when Paul Volcker raised rates to 20% to get inflation under control, is that that was a decade of inflation, right? So there'd been 10 years of inflation, so it took a 20 basis point hike to get inflation under control. We've had inflation for 18 months. It's been basically about a year of high inflation rates. That's not a decade. So it is true, Jess, that it's possible that it takes anywhere from 6 years to, as Ben Bernanke recently sort of stated, even 2 years. So 6 months to 2 years to see the full effects. You've got a tremendous amount of tightening sort of baked into the cake. But Jerome Powell has said he wants to see a meaningful decline in inflation. So I could imagine this scenario where, yes, they keep raising rates, 75 basis points at their November meeting, 75 basis points at the next meeting. That's going to take us to 4.5%, close to 5% on the Fed funds target rate. But if inflation continues to decline, right, so it's down from over 9% to 8%. If next month it comes down to 7.5 and then 7, then 6.5, then 6, by the time the Fed funds target rate gets to 5%, I can imagine inflation at between 5 and 6%. And at that point, as long as the trajectory is declining, and something else that I think the Federal Reserve will be watching closely, not just the unemployment rate and job creation, but job openings. So one of the issues right now for the economy is that labor is extremely scarce. And there are basically 2 jobs for every unemployed person. That's what it means by job openings. And so I think they're going to be watching that number very closely to see if they're having some effect on cooling the economy down from where it was a year ago. So those job opening numbers are going to be very important. They won't wait for the unemployment rate to increase. They'll just look at job openings instead.
Let's talk now. Let's start digging into the housing market and how this relates to mortgage rates. So we've obviously gone from record lows of the past 24 months, pretty steady increase, and it's continuing in those mortgage rates since the beginning of the year. How high are they going to go, and what's going to be the impact on the market?
Well, we know that mortgage rates obviously are affected by increases in the Fed funds target rate. And we saw mortgage rates go to 7%, basically. And I think, do we have a chart? Do we have a chart?
We do.
I think we have a chart. So sometimes at a time like this, it's good to put it into some long-term perspective because, here we have mortgage rates, and you can see that they have been sort of steadily falling from 1990. So this is a long-term chart. So sometimes in the midst of what feels unprecedented, it's really important to go back and kind of look and see sort of, does history give us any guide? Can we say, is there any time that looks a little bit like this? And certainly from 90 to 94, you can see that mortgage rates were above 7%, right? And they can spike, right? They can quickly go from 94 to 95, they jumped from 7% back up above to 9%. So big moves in mortgage rates are not unusual, but we've seen a long-term steady decline. You can sort of see this in the chart in sort of what we would consider to be normal mortgage rates. I do think that we're living through a time that looks very much like that 2000 to 2004 period. So look right there, you can see that mortgage rates were around 7% in 2000. This was a time when the Federal Reserve was raising rates aggressively. So that was late 1990s. Inflation was elevated at that point. Inflation was running over 5% back then. So inflation was high. Fed was raising rates. Mortgage rates go to 7% at that point. It had a big impact on financial markets. For those of you who remember what your 401k was doing back in 2000, 2001, stock prices started to decline, very much like what's going on right now. Money began to flow out of the most speculative areas of the economy. Back then, it was dot-com stocks. Right now, it's cryptocurrencies. So the situation at play today looks very, very similar to that late 1990s, early 2000s. So if anybody was in the business back then, they would remember mortgage rates going to 7%, refi activity completely stopped, right? Just like it's done now. So a year ago, it made sense for about a third of mortgage holders to refi. Now it makes sense for 1% of them to refi. So you're not going to see any refi activity in this kind of environment. But you still will see home sales. If you go back to 2000, 2001, 2002, existing home sales ran at a 5 million rate, right? Which is kind of normal. So what we have to realize is what wasn't normal were the last 3 years. What wasn't normal were houses selling sight unseen for $1 million, and oh, they don't have any bathrooms in them. That's kind of what wasn't a normal market, but we're just having a hard time adjusting. One of my sort of dear friends who's been doing this for a long time said, agents need to figure out how you're going to sell a house at a 7% mortgage rate, because that's the long-term average. 7% is the long-term average. And I'll, shout out to my friend Michael Saunders. She was the person who told me that. Been doing this for a long time. Houses can be sold at 7%. It's going to be a little harder than it was. And let me reiterate what I've been saying. You basically took 3 years of activity and squished it into 2. Because people could see that rates were going to rise, and so they locked in their mortgages early. They hurried up. That's why you had such a scrum in the housing market last year, because people knew rates were going up. So the fact that we sort of moved activity to last year means that in the face of these higher interest rates, you're getting a lull in the housing market. And it's sort of a return to normal. Now, how high can they go? Well, the chart shows you that they can go higher. It's possible. And I think as long as the Fed is raising rates, the really bad news is that rates are likely to continue to go up. But I want to say one more thing, Jess. One of the things that sort of I've observed over the last couple of years is that it appears as if markets are moving faster. They're moving faster, they're moving faster, they're moving faster. Part of it is an increase in transparency. And another part of it is the existence of algorithms and trading that is happening online, right? So basically algorithms that are trading and have nothing to do with you and I making decisions. And so all of that is making financial markets and interest rates surge and then come back down, and surge and then come back down. So I could imagine really a lot of volatility where mortgage rates, peak at 7%, and then suddenly we wake up tomorrow and they're back down to 5%. And then we wake up the next day and they're back up at 6.5%. Because I do think in stressful times like this, the movement back to normal gives you a lot of volatility that's coming because the nature of financial markets and how they operate seems to have changed. And part of that is that it's sped up the changes.
Muted myself with my coughing. Sorry, guys, I'm handling a cold as best I can here. So let's look at the bigger picture here, right? I mean, everything that we've been talking about. Prices have been cooling, but overall, they're still seeing, a positive increase in equity for homeowners. Jobs market is good, right? Inventory is super tight. Mortgages are high. Consumers are nervous. Talk us through. Let's not go too far in the future, but Q1 2023. What are we going to be looking at?
Sure. Well, I think you're going to, I think all the things that you sort of laid out mean that you don't get the downward pressure on prices and you don't get the panic selling of 2008, 2009, and 2010. So, as long as people keep their jobs and can make their mortgage payments because they don't have an adjustable rate mortgage, right? Which we know that they don't. And we haven't seen the third thing that really wreaked havoc on the consumer in 2008, 2009, and that was the all that refinancing that happened prior to the last housing bust, all that refinancing where basically people had bought a house at 200,000, refied it at 600,000 and took the 400,000 out and spent it on I don't know, shoes and handbags,
Right.
right? And so you had a lot of people with negative equity because of those cash outs that happened in the mid 2000s. Banks haven't lowered their lending standards. All these things mean that while you can have a slowdown in the housing market, again, like we saw in 2000, 2001, where transaction levels declined to something that looks much more, it doesn't look normal compared to the last 3 years, but it looks normal over the course of history, where you get existing home sales at 5 million a year instead of 7 million a year, like what we saw last year. So I do think that, and you don't get the price increases, right? You might get in some markets that have been so sort of blown up because of the pandemic rearrangement. I do think you're going to see a little bit of softness in pricing in those markets, but you don't have the imbalances in the markets that occurred in 2007, 2008, that delivered to you 2009, 2010, 2011. The situation's just not the same.
We're getting a lot of good questions here. It's almost bottom of the hour, but I think today is a good day to do a little post game, Marcy. Okay,
Yeah.
great. So before we turn to those questions, keep them coming, folks. I do want to acknowledge and talk a little bit about the awful situation that happened to Florida in the last couple of weeks with the hurricane, right? So talk a little bit about the economic impact, both locally and maybe some reverberations out of that. And also, I mean, we are seeing an increase in these kinds of natural disasters. So what should we be learning from these experiences? What should folks be focused on?
Sure. Well, I do think that it is very, very tragic, and it will certainly elevate the cost of building. So it was really, worst possible timing for builders and for supply chains. Just as things were starting to go back to normal, suddenly you're going to get this surge in demand for building products that will disrupt supply chains and continue that story 6 months out, 7 months out, 8 months out, beyond the return to normal. So that's just that's what happens when you have events like this. It's so unfortunate, the human loss, the human destruction, but it also, I believe, will sort of, it feels as if just as everybody moved to Florida, suddenly you get this giant hurricane to sort of remind us that that these things do happen, and that insurance really matters, right? And this is a moment when insurance markets step up and sort of remind people that check your policy and double check that you're properly covered for the things that can happen in your neighborhood. I am very concerned right now, and this will seem like a very sort of small thing, but one of the reasons that food prices are elevated right now is that the Mississippi River is very, very low, because we haven't had the rain, we haven't had snow over the last couple of years. And so you get a really low Mississippi River, and much of the grain that is produced in the United States gets shipped on the Mississippi River down to New Orleans and exported to the rest of the world. So this is exacerbating the food shock. I do think that we are living in a world where, much like 2000, or excuse me, much like 2001, right? September 11th, where we woke up, sort of went to bed on September 10th. thinking the world was one way. And we woke up on September 11th realizing that the world was far riskier from a terrorism point of view than we thought. So we had the same experience around COVID, that we thought the world was one way. And then you have this big event that shows us, oh, there are risks out there that we didn't quite understand. And I imagine that that hurricane, particularly for people who just moved to Florida, will sort of remind them that there are risks, and there are risks everywhere. I don't make me pick on Florida. There's tornadoes, there's tsunamis, there's all kinds of natural disasters that can happen, and it simply serves as a reminder to us to insure ourselves properly against certain inevitabilities.
Let's take some questions. Going back to the railroad situation, Stephen points out, as of 2 days ago, workers rejected the latest contract proposal. Is the strike a possibility? And if so, what would that look like?
Well, if they do strike, it will deal a serious blow to supply chains, which I believe is one reason why everyone is sort of hot and heavy to get a deal. That they now know they can hold out, but at the same time, I think there's going to be a lot of political pressure on both the unions and the owners to come to a settlement, because it would be extremely disruptive if a strike actually happened.
All right. We moved here from the UK 8 years ago. We're very relieved we did so. Do you think the pound will recover to the mid $130 in the medium term, 5 year?
Yes, actually, I don't believe that a dollar and a pound on parity makes sense. So one of the reasons, just for those of you who don't sort of follow currency markets very closely, the pound tends to trade between 1.3 and 1.5 dollars to the pound, right? So 1.5 being on the high range, 1.3 being kind of a little more on the normal range. Likewise with the euro. The euro's never been at parity with the dollar. It typically took about $1.20 to buy a euro. Currency markets, I believe, are telling us two things. They're telling us that the Federal Reserve is probably ahead of the curve when it comes to inflation relative to the rest of the world, hence the strength of the currency. So inflation erodes the value of your currency, your dollar, but if the Federal Reserve tightens policy, then that lifts the value of your dollar relative to everything else. So one message from the behavior of exchange rates is that the Federal Reserve, like Jess, you were saying earlier, may have done a lot of its work already, and that we could see inflation come down pretty dramatically very, very soon. That's one message. The other message, though, is probably that the U.S. being a net exporter of energy and a net exporter of food is in the better situation to weather those two shocks to the system. And so that strong dollar is a reflection of the relative economic strength of the U.S. compared to the rest of the world. So I do think, as the question sort of makes clear, currency markets tend to move very slowly. They're the cruise ship of financial markets. And if the pound being in this weakened state where it is, it doesn't tend to bounce back up very, very quickly. So I'm guessing that's a 3 to 4 year sort of phenomenon before you see markets get back to normal. And that's if Britain gets its act together. That's if they get their act together and things don't get any worse.
From Andrew. Hi, Andrew. Is there a correlation between higher mortgage rates, home prices, and the length of time between a buy-sell cycle for a homeowner? It seems that homeowners will have to hold their investment longer if it's more expensive to go through the buy-sell cycle.
Well, I do think you're pointing to something that I think there's been a lot of talk about, this kind of idea of lock-in, that essentially I locked in a 3.5–4% mortgage 6 months ago, and in order for me to move to a new home, I'm going to have to let go of that. And so basically, for any new mortgage that I get, my mortgage payment monthly is going to cost me basically 60% more than it did, last month. But there's a phenomenon out there that I don't think is being sort of talked about, and that is all the cash buyers who don't have a mortgage. So if you do get some weakness in prices, if you do get even price declines in some markets, anybody who paid cash for a house might be willing to let go of that house to jump to a nicer house. So even if they lost a little cash on the old house, if I'm looking to basically imagine I've been in Denver, right? So I've been in Denver and I basically have been trying to get into a house. I buy a 2-bedroom house that I'm not really crazy about. I pay cash for it because my parents helped me out. But suddenly house prices in Denver start to decline, and I have the opportunity to jump to the 3-bedroom house that I really wanted. I think you're going to get some movement there. And so, for those agents out there, do you have the list of people who paid cash for their houses? Are you keeping up with those people? Because they're not going to be stuck in this lock in to a mortgage the way that other folks are going to be. So, from a how do you run your business and how do you deal with things in this kind of environment, that may be sort of one possible tack to take in these kind of markets where people are going to be locked into a mortgage and um and, and not really want to sort of go through that buy sell experience again.
We are now well past the hour. We have a lot of questions that we didn't get to today. I apologize to everybody, but we got to let Marcy go here. We are going to be back next month once again. I'm sure it will be just as exciting next month as it was this month. Please join us again. Please come with your questions. We will try to regroup with everything that what we weren't able to address today.
Questions for our next session.
Exactly. Marcy, thank you for being here. I appreciate all of the audience, all of your questions, and we will see you next month. Bye, everybody.
Bye, everybody. Have a great day.